Hi, I'm Gio.
And I'm Oscar.
Welcome to the Come Up.
Today we're going to give you some tips and tricks on how to reduce your tax bill. We're not financial advisors and tax numbers change from year to year. That's good.
Yeah.
Okay, so before we get too far, I'm going to give a brief explanation of our progressive tax system. What our progressive tax system means essentially is if you're someone that makes $40,000 in income, okay, this bar here represents your income. It means that if you're a single tax filer, roughly your first $10,000 would be taxed at a rate of about 10%. The next $30,000 would be taxed at a rate of about 12%. It's not exactly 10,000, but I'm just rounding. And same thing here with the 40,000. That's not exact number that I'm rounding. And by the way, if you're married, filing jointly, or filing separately, or head of household, the brackets and the size of the brackets will change, but the concept remains the same. And so that's why it's called a progressive tax system, because as your income increases, you are progressively taxed a bit more on that income. And I should note that this is for federal taxes. Some states like California have a progressive tax brackets as well. And then you have some states like Texas that have no state tax at all. All right, Gio, you can come back. Let's take this out of the shot.
What? Already?
And we're going to post a link in the description to the federal tax brackets, so you can go and check those out in more detail.
So now let's talk about reducing your income taxes. From Oscar's example, the $40,000 is after deductions. The taxes that you pay on that can be reduced by contributing to a 401k or a HSA if your company provides those benefits. And if not, you can also contribute to a traditional IRA. And when you file taxes, the amount that you will have to pay taxes on will be lower. So therefore, the amount of taxes that you will need to pay are also lower. So what does that mean for your investments? If you bought a stock or ETF and sold it within the year, whatever profits you made are going to be treated and taxed the same way that your regular income is. So whatever tax bracket you're in for your income, that's what will be applied to your profits for selling a stock or ETF within 1 year. But if you bought a stock and held it for more than a year before you sold it, whatever profits you made on that are going to be taxed using what's called the capital gains tax, which is significantly lower. If you're someone making $40,000, then your capital gains tax would be 0%. If you're someone making, say, $60,000 or $80,000, then your capital gains tax would be 15%, but that would still be less than your actual income tax bracket.
What about real estate? Well, real estate gains would qualify as capital gains tax, right? So if you buy a house and you sell it, it would be treated under the same capital gains tax. However, there's a big loophole. If you have lived in the house as your primary residence for at least 2 of the last 5 years, then when you sell, you can get the gains tax-free for up to $250,000 if you're single, or if you filing jointly, up to $500,000. This can be a good incentive for some people. However, we're not saying you need to go out and buy a house just based on this, because of course there's a lot more factors to it. You need to make sure you're buying at a good price, that it's affordable for you, and many things. But it's just something good to be aware of. So if one day down the road you consider this as an option, then now you have the knowledge. As a last tip, we just want to mention that the IRS has a tax withholding calculator that you can use. If you have an employer, you had to fill out a W-4 form that tells the IRS how much money they should withhold from each paycheck. And so this calculator can be useful if you've had a life-changing event, like you got married or you had a child, which changes your tax situation and your tax brackets. And you can use this calculator to determine what should be the number of exceptions that you should claim on your W-4, and you can submit a new one with your employer anytime. Keep in mind, if you're someone that prefers to get a big lump sum back on your tax refund when you file for taxes, then you may want to consider that when you get this calculation, because what it's going to do is going to tell you how much you need to, what number you need to put down in order to meet your tax obligation. But if you want them to withhold more from your paycheck, then you can adjust that number and you can get your bonus. You can think of it as a bonus, right? When that check comes in, it is a preference, right? Whatever you prefer.
So thank you for watching this video. If you like the content, please like and subscribe. It helps us with the YouTube algorithm. And please drop us a comment. Let us know what you like or didn't like and what other topics you would want us to cover. And see you next week.
See you next week. Okay. I was like, oh, he's so good. He got it. And then you throw in Roth. I was like, oh.
Traditional TD Ameritrade. We're waiting for a sponsorship.
We're going to post a link in the description to the federal tax brackets so that you can go if you wish to review those for your status as well.